3 weeks ago, oil spiked 80% to $119 a barrel, the S&P dropped, the VIX surged 70%, everyone panicked. The Trump paused the strikes, peace talks started, and oil dropped 11% in a single day. Now, it's hovering around 102, and nobody knows what happens next. Here's the thing. This has happened before, not once, not twice, at least 5 times in the last 50 years. A war breaks out, oil spikes, markets tank, and everyone loses their minds. So I put 50 years of data to see what actually happens, and the pattern is so consistent, it's almost boring. Let me show you. On February 20th, the US and Israel launched nearly 900 airstrikes on Iran in 12 hours. 4 days later, Iran closed the Straits of Hormuz, the choke point for 20% of the world's oil supply. Brent crude was sitting around $69 a barrel before the strikes. By March 9th, it hit 119. That's an 80% spike in 10 days. For context, this supply disruption is roughly 3 times larger than 1973 oil embargo. The IEA called it the largest supply disruption in the history of the global oil market. They responded by releasing 400 million barrels from strategic reserves, also a record. The S&P dropped 5.4%. The VIX, the market's fear gauge, surged 72%. Energy stocks ripped 21%. Airlines got crushed, and everyone started asking the same question: is this the big one? Let's go to the data. I looked at every major oil shock since 1973, 4 events, 4 oil spikes, 4 market reactions, and a very clear pattern. 1973, the Arab oil embargo. OPEC cut off oil exports to the US, oil went from $3 to $12, a 300% spike. The S&P fell 48% over 21 months. It took nearly 6 years to recover. That's the worst case, and I will come back to why it was different. 1990, the Gulf War. Iraq invaded Kuwait. Oil doubled from $21 to $46. The S&P dropped 17% in 3 months. But here's what's interesting. The market bottomed in October, 3 months before the war actually started, and on the day Operation Desert Storm launched, oil crashed 33% in a single day. The S&P jumped 3.7%. 1 year after invasion, the S&P was up 8.6% from where it started. 2003, Iraq. This is the textbook case. The market fell 15% in the months before the invasion as uncertainty built. Then the day the bombs started dropping, oil actually fell. The market bottomed, and over the next 12 months, the S&P returned 35%. 35% from the day the war started. 2022, Russia invades Ukraine. Brent spiked to $139. The S&P fell 25% over 9 months, but energy stocks returned 64% that year. The only sector in positive territory. 15 months later, the S&P hit a new all-time high. When you line this up, the pattern jumps out. JPMorgan studied 36 geopolitical events going back to 1940. Here's what they found. The average drawdown, negative 4.7%. The average time to hit bottom, 19 days. The average time to fully recover, 42 days. And the S&P was higher 1 year later about 70% of the time, not 50-50, 70%. The 6-month return after a geopolitical shock, 2.6%, positive as if nothing happened. Markets don't care about wars, they care about uncertainty. And once the uncertainty resolves, even if the news is bad, markets reprice and move on. But there's one event where this pattern broke, 1973. In every other oil shock, the disruption was temporary. Weeks, maybe a couple of months. Oil spiked, then fell. Markets followed. In 73, OPEC kept the embargo going for 6 months. Oil stayed expensive. The economy tipped into stagflation. Rising prices and rising unemployment at the same time. That's the toxic combination. So the question for 2026 isn't, is this bad? Obviously it is. The question is, how long does the Straits of Hormuz stay closed? If it reopens in weeks, we are looking at 1990. A scary spike, a sharp recovery, and life goes on. If it stays closed for quarters, we are in 73 territory. JPMorgan puts recession odds at 35%, Moody's says 49%, the Dallas Fed estimates that just 1 quarter of closure knocks nearly 3 percentage points off GDP. That's the only variable that matters, duration. While you are watching the S&P number, the real story is happening underneath, in the sector rotation. During the 2022 oil shock, Energy stocks returned 64%, consumer discretionary fell 37%. That's a 97 percentage point spread in 1 year. It's not random. Every oil shock triggers the same rotation. Energy and defense go up, airlines, retail, and consumer discretionary go down. Utilities and healthcare hold steady. Academic research out of the University of Kentucky found out that energy stocks don't just spike during oil shocks. The outperformance persists for 4 or more years after the initial shock. On the losing side, airlines get hit the hardest. Fuel eased 20 to 25% of their operating cost. Delta estimated that every single penny increase in jet fuel cost them $40 million a year. Most major US airlines have stopped hedging fuel entirely, so they are fully exposed. Right now, in 2026, the energy ETF XLE is up 21% year to date. Lockheed Martin is up 29%. Meanwhile, airlines dropped 2 to 4% on day one and haven't recovered. The market isn't falling equally. It's rotating, and if you're not paying attention to where you are concentrated, you might be on the wrong side of it. Here's the part nobody wants to hear. The biggest risk to your portfolio during a crisis isn't oil prices. It's not the Fed, it's not even recession. It's you. Delba has been tracking investor behavior for 30 years. The average equity investor underperforms the index by 3.5% per year, not from bad stock picks, from bad timing. Panics selling at the bottom, FOMO buying at the top. Hartford found that if you missed just the 10 best market days over a 30-year period, your returns get cut in half. Here's the kicker. 76% of those best days happen during a bear market or in the first 2 months of a new bull market. The best days happen when things feel the worst, and that's exactly when people sell. So the data says the biggest returns come from right after the biggest scares, and the people who missed them are the ones who panicked. So what do you actually do? Here's the framework I use whenever a crisis hits. Question 1. Is this priced in? Oil already spiked to 119 and retraced to 102. The S&P sold off and partially bounced. Energy is up over 20% year to date. The market has already moved in both directions. The question is whether the current price reflects a reasonable worst case or if there's more to come. Question 2. What's the historical base rate? 50 years of data say average drawdown is about 5%, recovery takes about 42 days, markets are higher a year later 70% of the time. The one exception requires 6 months of sustained supply disruption. Is that likely here? Maybe, but the base rate says probably not. Question 3. Does your portfolio need rebalancing or just patience? Check your concentration. If you are 90% in tech and 0% in energy, the rotation is hurting you more than the drawdown. If you are diversified, the answer is probably patience. If you are concentrated, this might be the nudge to fix that. This isn't about being bullish or bearish. It's about replacing panic with a process. If this kind of breakdown is useful to you, I share stuff like this in my newsletter. Data breakdowns, investing frameworks, free tools. I drop them as and when I find something worth sharing. No schedule, no fillers. Newsletter link is in the description. Subscribe to the channel if you want more of this, and I'll see you in the next one.